You see this kind of thinking and rationale, and it's actually kind of sad. Hey there, and welcome to my channel, Paperback Investor. Today's video, I want to briefly look through a Twitter thread from a guy named Christopher Bloomstrand, pretty prominent Twitter voice and Tesla critic, as he tries to tear apart the Ark Invest's new $3,000 price target. I want to explain why his thinking doesn't make sense overall for the whole price target as he tears apart their insurance side of the price target, and how some of the comments are kind of revealing some people's own biases and I think sort of short-sighted analysis and thinking when it comes to Tesla. And hopefully this can help you understand and evaluate correctly, truthfully, Tesla stock now and for the future. So let's get into it. Before we go any further, absolutely clear, not a personal financial advisor, just a guy with a bag on his head. I love investing, I love thinking about the future, but make sure you do your own due diligence. Let's look at that Twitter thread. So Christopher Bloomstrand, he says, I see a lot of student write-ups and pitches. Most are better than yesterday's $3,000 Ark price target report for Tesla. And reading the report, it's clear the motivation is to promote a higher stock price. The fantasy involved is simply spectacular. Okay, so I saw this tweet and I thought, wow, okay, what's he going to talk about? Like, I'm geared up, like ready to hear his understanding, his thoughts about full self-driving, because that's about half their sort of their average price target of $3,000 is sort of in that range. So then he goes on, says, let's go right into the insurance valuation and model update, where the analysis assumes in a bear case Tesla's insurance operations were $23 billion in 2025, 4 short years from now. It's clear the author and firm have no clue how insurance works. Harsh, I know, however. And he goes on, and it's a very long Twitter thread. I think it's like 33, 34 tweets long, so I'm not going to read every single tweet. But he basically goes on for 30-some tweets about the insurance side of the business. And I was reading through it, and I kind of kept thinking, where's the rest of the analysis coming from? You know, he trashes their whole $3,000 price target, but most of their price target has nothing to do with insurance. In fact, insurance only accounts for, if we flip to their price target to their analysis, insurance only accounts for about $60 of the price target. So it's only a tiny, tiny little portion, but he goes on and on and on. Okay, so he talks about insurance, and I think he's making some good points about why they're overly bullish on what their insurance could offer from Tesla in just a short amount of time. But he goes on and on. He also points out with all expansion they're doing, this is a really good point, all expansion they're doing, how are they going to get to the $23 billion in annual premiums and expand, at the same time expanding their auto production? Maybe it's not realistic. Maybe the insurance really isn't going to pan out in their model as they have modeled it. And he makes a point as well, they're not even their underwriter themselves right now. That's sort of subbed out to somebody else, and they're more of just an insurance agent really at this point, selling the insurance broker really. Selling direct to their consumers, I think only in one state. But he goes through all of this, and I'm reading this tweet just waiting. Okay, the $3,000 price, most of the price comes from, if you read their report, most of their price comes from full self-driving. It's the software play that is Tesla. They're going to sell a really, really high margin income through software that's going to be full self-driving. That's the sort of that's where they're going to make all their earnings, and why I think Tesla's still a really good buy at the current price. But he doesn't talk about that at all. He talks entirely on and on and on about this insurance. So I tweeted back to him and I said, I wish you would have discussed more details around the main drivers of the market cap, such as robotaxis, instead of insurance, which is a tiny sliver in their model. And picture market cap by business line in our expected value case, $3 trillion market cap. You can see insurance. This is insurance. Literally, it's $60 out of the $3,000. It's like the tiniest little sliver. It really has nothing to do with the business. It's something they added in, sure, to this analysis. They could have just kept not even done it, but maybe it's totally bogus or and doesn't, not important in any way. But he made zero arguments about the rest of the pie. And I just, honestly, I was like kind of taken aback that he bashed their whole price target so badly and then made no arguments for almost anything but this tiny sliver. Makes no mention of the full self-driving technology, realistically, whether they could achieve that or not. No mention of that. And other people agreed with me. Obviously, some people disagreed with me, but there were some good comments in here, and some of them I thought were kind of revealing, even to my own tweet. Some people really loved it. And other people replied as well. Rohit here, I think the point of the thread is that the supposedly small sliver of the valuation is not really small. Well, no, it's odd to me, this kind of thinking and reasoning you see people online. No, it is small. It's literally $60 out of the 3,000. Like what you just said there, it's not true. Like the point of the thread is that the supposedly small sliver of the valuation is not really small. No, it is $60, Rohit. And if you make a foundational mistake like this, other numbers can't be relied on. I mean, I see that helps me. There's more, that's a better argument there, what he's saying. If they make a foundational mistake like this, other numbers can't be relied on. And this is kind of something I saw in a lot of comments, people replying to this. I mentioned here that I don't consider it, foundational, Tim. And I also want to mention another comment on my post here. Is this guy said, if Ark got the insurance piece so wrong, it calls into question the rest of the report. And to me, this is, I replied to this guy named Don. I said, that helps me understand this thinking more, but it's also the definition of reasoning by analogy versus first principle reasoning thinking. If you think the insurance, basically his argument boils down to the insurance portion is so bad that it must mean the rest of the argument is bad. But you're doing nothing to evaluate the rest of their argument. It's like a really short way of drawing a really simple conclusion that might be the right conclusion, but very well could be the wrong conclusion. And to me, it's just a great example, and the comments section on this whole post are just filled with people saying, yeah, great job, good job there, good job pointing out how bad they're hey, good job, Chris, pointing out how poorly done their whole analysis is. Well, he really hasn't touched on their analysis at all, and his argument is about this tiny sliver. I mean, maybe the rest of the argument's crap as well, but at least you should focus on that. And so it really shows me, to me, this is just a wonderful example of reasoning by analogy versus first principle reasoning. First principle reasoning, you have to think about the exact thing, boil down the actual thing you're looking at, what actually matters, boil that down to the most fundamental elements.
Tend to think by analogy or by comparison with something that already exists. And this is a sort of a mental shortcut that requires less brain strain, but it does not, it's hard to get fundamental insights unless you think about things from a first principle standpoint.
This is the full self-driving piece of the puzzle. You can see this graph in their report, and boil down Tesla's full self-driving strategy. Does their strategy make sense from like a nuts and bolts first principle perspective? Can they actually achieve full self-driving? Are people actually going to pay for full self-driving? If you can answer those questions clearly, or you can say why they're not, then that's a great argument on why their whole $3,000 argument is bogus. But his argument that he goes on and on for 30-some tweets about this tiny little sliver, I thought was like almost laughable. Just odd to me, and just odd and almost actually sad to me to see people just applauding this argument and saying, hey, if that's wrong, then how can you trust anything, kind of an attitude. I really thought found this sad, because really I can see this, if you go back in time a couple years to Tesla, let's just back up here, like look at a 5-year chart of Tesla. If we go back to 2018, 2019, the stock was in pre-split was like 300 and some, I guess 60 after the split, and then went down all the way to like lows of around 40. It was around that $200 mark pre-split, or $40. And there was so much of this really, really poor reasoning going on, just like just circular, ridiculous reasoning by analogy. Hey, Tesla doesn't make money. They're not a profitable company, so they're going to go bankrupt. That was like a lot of people's entire argument. They hadn't looked any deeper, and it was just very surface, very just quick analogy kind of, oh, they don't make money, they must be going bankrupt. Oh, their cars are catching fire. I saw a headline about that. Oh, all their cars must be unsafe. You know, there's no kind of more truthful looking at the details and trying to drill down from that first principle standpoint. So to me, it's sad because there would be many people in this range who shorted stock heavily, many people that could have invested in the stock and didn't, and they could have made amazing, huge profits over the last couple of years. And you see this kind of reasoning again, like Don here with the CFA, who says it calls into question the rest of the report. I mean, to me, sure, you can question it, and then do the analysis on the rest of the report. And there's no analysis done here at all, and then a bunch of people kind of slapping each other on the back and high-fiving each other, saying, wow, you know, Tesla's a garbage, the stock's trash, these Ark Invest people are a bunch of morons. You know, really is sad to me to see this kind of reasoning. Okay, that was a little bit long-winded, but I hope you got some value out of this video, and I hope you saw this idea of seeing things and reasoning from a first principle standpoint more clearly from this video. And why, in my opinion, that's so important if you really want to try and get to the truth of anything in life, whether it's stocks or anything else. You're really trying to see something clearly on how something actually works. You have to come with an open mind, open heart, and try to reason all the way down to the most sort of fundamental first principle truth you can find. If you can do that, you can do very, very well investing and all kinds of other things as well. Okay, I'd love to hear from you guys. Let me know in the comments down below what you thought of all this, what you thought of Chris and his Twitter rant thread thing on insurance. And if you got value out of this, hit that subscribe button as well. Thank you so much for watching. I'll see you in my next video. And remember, it's in the bag. Cheers.